Hi, everyone, and welcome to Swim with Jim. This is your host, Jim Ludwig from Main Street Financial Planning. Thank you, everybody, for joining us today. We're excited to have with us Tim Jackson from Reverse Mortgage Funding. Tim, are you there?
Yes, absolutely. Thank you very much for having me on today, Jim. I'm excited, and this is an honor.
Well, thank you. And one of the reasons that we're talking about reverse mortgage funding today is last month at our Garrett Planning Network. Garrett planners are the hourly planners. We had a presentation from a professor at Texas Tech University, where they have a financial planning program, including a PhD in financial planning. And he gave a presentation on reverse mortgages and a special use for certain kinds of clients. And we're going to talk about that in a few minutes. But first of all, can you tell us what is the history of this program that's called the Home Equity Conversion Mortgage?
Sure. So to give you an idea, the home equity conversion mortgage was signed into law actually under the Reagan administration. It didn't come into effect until 1989, and over the course of the last few years, we've ranked up just shy of 1 million older Americans in this country have taken advantage of the FHA home equity conversion mortgage. A few of the features in it is there's a $105 billion insurance that is in full force and regulated by the federal government, which allows this mortgage to operate much differently than a traditional mortgage. As of April 27th of 2015, we saw some enhancements made to the reverse mortgage, which is the reason why Dr. Salter, who you saw from Texas Tech, and many other academics in the financial planning field are getting so excited about the reverse mortgage, as well as the recent media hype around the program. These enhancements have not only garnered respect and comfortability, but it's plain and simple changing the way people are strategizing their retirement today.
So the program today, I've billed it as using a reverse mortgage for old age insurance. Can can you describe who's been using these vehicles and how they've benefited?
Sure. That's a great question. So, what we're finding is that there are four common uses for reverse mortgages out there. The easiest to describe, the one that's put on commercial most often, is that you can have your home pay you tax-free, guaranteed for the rest of your life. And today, for the low cost of $125 in most states, what you'll find is a 62-year-old in a $625,000 home would be eligible to receive $1,800 a month tax-free, guaranteed for the rest of their life. So for anyone who's looking for a way to fund their retirement, this obviously can be an added extra source of income to keep them in their home. However, that's just one of the four ways that people are utilizing the reverse mortgage. And did I explain that okay, Jim? Did you have any questions about that particular usage?
No, that's the normal one that we see, that I'm running short of money and I don't want to leave my house. How can I tap into this equity?
Correct. And to answer your question fully, you had said, who's benefiting from this, and really what we're finding are people with assets in retirement anywhere from 100,000 to just upwards of $1 million are taking advantage of that extra income when they take a look at what their retirement is going to cost and the risk of longevity out there. They're finding that the reverse mortgage is a beautiful complement to a healthy retirement plan. So where the academic research has been focusing on has been the reverse mortgage line of credit feature. Essentially, it's a flexible payment line of credit that has an enhancement to it that doesn't exist with regular mortgages out there. The academics are excited because it can't be called, canceled, or reduced at any point in time. So, to give you an example, a client, again, same age, 62 years old, in a $625,000 home would be eligible to receive a line of credit initially. For $125, they could open up a line of credit for $325,000. The interesting piece of this is that the line of credit is then, from the point that they open it up, is then going to grow in available funds over time. So if you were to take a snapshot of this line of credit 10 years from now, you're going to find an available line for $613,000. If you looked 20 years into the future, that line of credit is going to grow to $1.1 million, tax-free, guaranteed, no matter what happens to the value of the home. So what that does to someone's financial picture, when you say longevity insurance, and many people are comparing this to longevity insurance, to be able to initiate the program for $125, if 10 years down the line, they don't need it, or they want to sell the home, then that's all that this has cost them if they haven't borrowed anything. For 20 years down the line, if they don't need it again, you've got your initiation cost. But to be able to set up a guaranteed increase in the value of your home, which you'd be allowed to tap into at any point in time for any reason, it's a game changer. It's a game changer today, and many different retirees today are taking advantage of it, and more planners are getting behind this strategy, which is proving to be vital for many people. Does that explain itself?
Yes, Tim, very well. That if you don't have a $600,000 house, you have a $200,000 house. Is it really 1/3 of the numbers that you were using previously? Is it arithmetically the same?
So not dollar for dollar, but that's a pretty good estimate. Because again, the costs are going to be relatively the same. The line of credit grows, ironically, at the exact same rate of interest that you would have been charged on any money that you borrow. So, if you were to set up a line of credit of $100,000 as opposed to $300,000, you would see it increase very similarly in the amount. Without having my software in front of me to run an illustration, I couldn't say exactly, but you're right on par with that statement.
So that increase that you contract for at the origination of the line of credit, that stays the same throughout the life of the loan?
That's a great question, Jim. It mirrors the interest rate that the client would be charged on any money that they borrow. Now, right now, we're at a very low interest rate environment. So for someone to open up a reverse mortgage line of credit today and not touch it, if we saw interest rates increase, you would then see that exact same benefit passed on to the line of credit. Most of these are coming with a 5% cap. So if we saw rates shoot up to 15%, there would be the cap there. However, there are other programs that are being utilized with a 10% cap on it. It has a lot to do with the strategy that the planner and or the prospective borrower or client would be looking to implement.
How about those other two uses of home equity conversion mortgage?
Sure, and I'll get to those in just one moment. I wanted to make sure that we had that part of scenario 2 down, because what really becomes interesting is if we get behind this concept of growth in the line of credit. A $1.1 million line of credit 20 years from now would be growing at approximately $65,000 a year if rates stayed the same, right? If they went up, we would see a greater growth than that. However, where rates are today, you'd see a $65,000 growth. And the client at that point, if they wanted to pull down from that line of credit $65,000 a year, they could do so every single year for the rest of their life and still have the $1.1 million line of credit in place. So to finish the concept of using the reverse mortgage for it as a complement to longevity insurance, to be able to initiate this for $125 to give guaranteed income 20 years from now of $65,000 a year is a game changer. Um, does that explain itself as well, Jim?
It does. And can you address the issue of why the price is now $125 for this program? Because of my experience in past years, it might have been $3, $4, $5,000.
Sure, sure. And I've been providing reverse mortgages for 12 years. I can remember when they were even a lot greater than that. There were two main things that occurred with the reverse mortgage. One, again, was the regulatory environment that we live in today helped to drive costs down. And since the excitement around the reverse mortgage has started to grow, we've seen a different appetite in the secondary market. The fact of the matter is we live in a capitalist society, right? Supply and demand, and what we're finding now is the implementation of reverse mortgages are being used in a fashion that allows certain companies, and unfortunately not all are able to do this, but for the company that I work for in particular, we service our own loans, and therefore we're able to make our profit over the long haul rather than having to charge hefty fees up front. So that should explain that.
Okay. You want to cover the other two?
Absolutely, absolutely. So, another neat strategy are for clients who still have a mortgage on their property. I had a planner come to me about a month ago. We had a client who was making $1,500 a month principal and interest payments on her home. She was, in order to make those payments, she was pulling down funds above her RMDs. She was being faced with tax consequences as a result that made this $1,500 a month payment, or $18,000 a year, it made it increase to $28,000 a year because she had to cover the tax consequences of pulling that money out of her IRA at 62. Now, in addition to that, pulling that money down was increasing her income to a point where it was affecting the bracket that she fit into for Social Security. So the total cost of this, with the reduction in Social Security that she was getting because of the added income she had to pull in order to make her mortgage payments, was roughly $36,000 a year. So for this client in particular, we were able to pay off her current mortgage and eliminate that mortgage consequence, to eliminate that mortgage payment for the rest of her life. It's pretty darn exciting when you start putting this into financial planning software to see what that kind of a difference in payment can create to someone's lifestyle, and what that can do to someone's plan overall in the hopes of being able to achieve their goals. Do you have any questions about that concept, Jim?
No, that one sounded really great. In fact, we come across people frequently that have the need to stop that mortgage payment, and this is a great idea on how to do that.
Great. Yeah. So the last bit is a pretty exciting piece. It's called the HECM for purchase, which baffles people sometimes. You can buy a home using a reverse mortgage for purchase today. So to explain this, the simple way is to say, well, look, you can buy a home today with a mortgage with payments, or you can buy a home today if you're over the age of 62 that is payment optional, that has a flexible payment schedule. So your clients would be able to make payments on the mortgage if they want to, but they're never required to. So they're never at risk for losing their home for non-payment of funds. They still have to maintain their property taxes and homeowners insurance and make sure that the roof doesn't cave in. But the idea is today people are using, they're going to be purchasing, rather than tapping into extra retirement accounts or funds that they don't want to touch. There are many people who are right sizing as a buzzword today, where you'll see that they want to go from a $700,000 home down to a $500,000 home. So their options are to sell that $700,000 home and buy the $500,000 home cash, putting $200,000 away. When you throw the reverse mortgage for purchase in the mix, it allows you the ability to only put 50% down on the home. So that same scenario would allow a client to place $250,000 down on the home and keep the remaining $450,000 that they made from the sale of their previous property, all while moving into the retirement of their dreams and not being forced to make mortgage payments. Does that explain itself, Jim?
I think that's pretty clear. I think people, though, may have some more questions, not only about this fourth way of being able to buy a house using your current home equity as you transition into maybe a right-sized house, but on the previous three models, including that line of credit that can grow very briskly over a long period of time and into people's old ages. I think what we're going to do, Tim, because our time's just about up, is we're going to put some additional information that people can get. Can you name a few of the sources, and we'll put it down in the comments below?
Sure. As far as being able to get a hold of question?
A hold of where you can find information from HUD and from other sources, including your firm.
Great. Yeah. So if you were to go on to HUD.gov, they have information about the reverse mortgage program. You can also check out our trade association, NRMLA, the National Reverse Mortgage Lenders Association, which is spelled NRMLA.com. They'll talk about the new reverse mortgage, which is what we were talking about today. Or you can stop by my website, which is reversemortgagefunding.com/Tim-Jackson. Or anyone is welcome to call me toll free at 1-800-912-5001. That would always go directly to me. And if you had any questions or concerns, I'd be more than happy to answer whatever I could.
Well, Tim, it's really been great interviewing you today and finding out about using a reverse mortgage that now costs a lot less as far as out-of-pocket fees to maybe have some additional funding in old age. And so I'm going to call it old age insurance. You've been listening to our monthly broadcast of Swim with Jim. This is Jim Ludwig from Main Street Financial Planning, wishing everybody a good day, and in the comments below. Thank you, everybody. Bye, Tim.
Take care now.